This is Breaking the Mould, our regular look at the financial markets with our investment director, Russ Mould. Looking very dapper, Russ.
Thank you, Claire, and you're looking very pretty too, may I say. Going somewhere
you.
special?
Yeah, I'm off to Royal Ascot.
Fantastic. Well, I look forward to seeing you there on the Friday. Car park 7, lunch 11:30. Bring a bottle.
Sounds like a fuss.
Perfect.
But Russ, what else is there to be making a fuss about?
Well, to be honest, 5 days of top quality flat racing in Berkshire is going to dominate the attentions of quite a few trading desks this week, particularly mine. But corporate news is a bit thin on the ground, truth be told. We do have full year figures from aerial platforms expert Latchways on the 15th, structural steel turnaround story Severfield on the 17th, and gold digging disaster Petropavlovsk on the 18th. All are worth keeping an eye on, but for me the really interesting story of the week, apart from the Group 1 coronation stakes on the Friday, is going to be the payment on the 15th of Spirax Sarco's special dividend.
Okay, cash in the hand can be welcome whether you're at the racetrack or not, so let's get under starters orders.
Right, we're off. Okay, so Spirax Sarco is a FTSE 250 firm actually based in Cheltenham, another famous racecourse, albeit over the jumps. Now, it's a specialist in steam systems and the efficient use of steam. Its precision kit helps customers cut energy consumption and carbon emissions, boost productivity, and even help with worker safety, so it's all good stuff. Now, a 22% operating margin tells you that customers value its products and services very highly and that the firm is good at providing those services. That return on sales means Spirax Sarco's cash generative. It ended last year with net cash on its balance sheet. Now, that in turn meant the company could hike its full year dividend by 9% to 64 pence a share and announce a 120p a share special divvy for good measure. Add those up, the historic yield's in around the 5% range. The shares have lapped it up as the chart behind us shows.
That's all well and good, but I feel like what you're doing here is telling us what's won after they've passed the post.
Experts are good at that, that's why I'm here, so that's not a problem. But we will be galloping off to the champagne bar in a minute, but with the dividend yield perhaps. But I don't want to talk about whether Spirax Sarco is a buy or not. That's advice, and I'm not in the tips business despite this week's horseplay. What I do want to talk about are dividends, special dividends and buybacks, so investors know what to look for if a company makes an announcement.
So, which is best for investors? Is it dividends or is it buyback?
That is the magic question, and in the end, there's no, real right answer. That will depend on an individual's personal circumstances, investment goals, time horizon, and perhaps even tax status, but I can offer some helpful pointers, which is probably more than I can do for the Group 1 coronation stakes. Now, in dividends, Professor Jeremy Siegel's book, Future for Investors, shows how the highest yielding US stocks have consistently outperformed the market on a 50-year view. Now, the bars on this chart rank the US stock market into 5 portions weighted by market cap, and the 2 segments with the highest dividend yields showed the best average total annual return. As an aside, they also did that with lower volatility.
Have you got an example of this closer to home?
Yeah, I don't keep rabbits in this thing, I hasten to. I don't know, my children do, but in fact, on this occasion, I do have a solution. Since the institution of the FTSE All-Share in 1962, the index has generated a compound annual capital return of 7.1% and chucked in a 3.4% average annual dividend yield for good measure. So this chart here shows what would have happened had an investor put £1,000 into the market 53 years ago and generated the same returns with and then without that dividend reinvestment. So just based on the historic returns. Now the gap, which for simplicity's sake excludes fees, commissions and tax, barring the 10% dividend withholding tax, is quite startling between the two. Yeah. No dividend reinvestment, dividend reinvestment. Now there's clearly no guarantee past performance will be repeated, particularly those percentage returns, but it does make a strong case for dividends and for dividend reinvestments, although again notice, companies can and do cut their dividend payments during market and economic downturns. We all must therefore do careful research on companies' finances to ensure the dividend cover is adequate and the shareholder distributions are safe.
Okay, Russ, that's dividends. What about paybacks?
Okay, well, history shows companies have a habit, and it's not always a good one, of buying stock back during bull markets when their stock tends to be more expensive because it's gone up a lot, and not buying them back during bear markets when the shares have gone down and in theory are cheap, which sounds entirely counterintuitive. As someone who's covered stocks as a fund manager, analyst and journalist for nearly 25 years, I don't think I've ever met a chief executive who told me your stock is overvalued, so they can sometimes buy stock back at the wrong time. Now, it's not just to say that they're inherently a bad idea. Just look at how the NASDAQ US Buyback Achievers Index has done since its inception in 1966. It's a basket of stocks who regularly buy back shares, and it's beaten the Dow Jones Industrial's hands flat. It's risen more than 8-fold against the Dow's, still impressive, 233% gain. However, I think it's fair to say that buybacks probably work best when There's highly visible cash flow and a strong balance sheet that mean the company can actually sustain the cash outflow. The business doesn't need major capital investment to maintain its competitive position. When the balance sheet's strong, because let's face it, borrowing to do your share buybacks isn't a great idea because that's money gone. And that's also subject to the 2 points above that the balance sheet can take it. And also in the end, the shares are just cheap because that's when it really does pay. I'd be very careful if your firm is borrowing to fund buybacks, especially if those plans leave the balance sheet looking a little bit stretched. So when a buyback's announced, you need to, again, do your own research. DYOR, which is what I'm about to do right now, if you'll excuse me.
Thank you, everyone. So remember that, do your research. Russ, we'll have a great day at the races.
I look forward to seeing you for that picnic.
Hopefully you do too. We'll see you next time. Goodbye.